So, Bruce, we had a little twist in the story yesterday with the Pfizer news, which the market took extraordinarily well. I'm curious if it changed anything about your timeline or base case for this pandemic.
Hi, Bonnie, and great news for Pfizer, and it's going to be a long winter for sure. Caseloads we're hearing about in Italy, but around the globe here in the United States, soaring, hospitals filling up, and so I think the most relevant, kind of conclusion I come is remain very vigilant and don't let your guard down. The markets, they'll give us better definition as to timing, and so healthcare sector is back in favor again, and credit's heating up. So we like this trend. We like what we see, and there's lots to do.
Yeah, it's interesting though, Bruce, because the credit markets in a lot of ways look a little bit like they did in February. So when the Fed stepped in, it sort of rained on the parade just a little bit. What are you anticipating now in terms of things like default rates, the probability for fallen angels and so on?
Well, liquidity crisis is, stopped dead in its tracks when the Fed came in with $4 trillion of QE in a matter of 5 weeks. Remember back in 2008 and 2009, it took 5 years for QE1, QE2, QE3 to put $4 trillion of liquidity in the system. And so the high yield index as we sit here right now today is the lowest on record ever, right? At 4.75%. And issuance, meanwhile, because of the ability of companies to issue, is a record year of issuance. We've already seen over 400 billion of issuance. And so what's really interesting about this dynamic is that coming into COVID, 50%, actually less than 50% of all high yield had double B ratings. And today, because the high yield issuers with the better ratings are issuing, today it's 56% are double B issuers. And remember, back in 2008 and 2009, only 40% of high yield issuers were of double B rating. So what we're seeing right now is we're seeing a tale of two cities, Bonnie. We're seeing balance sheet leverage, which is huge, by one cohort. And so you look at the leverage loan index and debt to EBITDA ratios are in excess of 6.5%. And so it truly is a K-shaped recovery. We believe, significant restructurings on the horizon. And so when you look out this next year or two, default rates will probably stay elevated, I think around 6% in 2021 and 2022. And amend and pretend will be back in vogue in a big way. Right now, today, there's 100 companies in the U.S. who have missed, middle market companies, who have missed interest payments, and active negotiations are going on right now. So Marathon, in fact, has a proposal out with the company. It's being documented right now with their lawyers, where we're finalizing new money solution to keep the company out of bankruptcy. Very low coupon, but a big, huge above market pick. So we earn a lot of interest on the accrued basis, and we're taking a good chunk of the equity from the sponsor to also tie that to the debt financing that we're providing. So the bottom line on all this, Bonnie, is I think 2020, there'll be $200 billion of defaults in the high yield market, and 2021 and 2022, with default rates at say 6%, at least 100 billion each these next couple of years. So we're finding compelling opportunities. Security selection is key, of course. And I think you want to ride this horse, the credit horse. It has legs, and it has legs for both what's performing and what needs new money solutions. But you need to be very vigilant and stay away from companies and industries that are in structural decline.
So, Bruce, you mentioned the default rate there are at around 6%. So thanks to various factors, not the 10 or 12% that you might have seen originally. What about the timeline, this massive bout of restructurings? Is it taking place right now, or are companies still riding it out a little bit?
Well, take the airlines, for instance, right? So they come into COVID and they have $50 billion in debt coming into COVID. And today, this is the big three I'm talking about: Delta, United, and American, right here in the United States. $50 billion of debt coming in. And today, it's the same calendar year, they have $110 billion of debt. So you tell me, with this huge cash burn, no profits at all, and the business traveler and full planes is how they lead, how they get to profitability. And so even with the vaccine, it'll take years for this industry to return to its old trend line. And so we'll get the profitability, and we like the airlines industry and travel in general, but the footprint is just too big given their level of indebtedness. And so we'll see several bankruptcies. including some majors globally and here in the United States, that'll file for bankruptcy. So that's one case in point. Take another industry that maybe doesn't come back the same way, the theaters. And the big ones, obviously, AMC and Cineworld. And you tell me, disruption from Netflix and streaming did a lot of harm prior to COVID. And, Disney Plus is just a pile-on to that. And so this is an industry that's in structural decline. And so we avoid that. Kind of back to the flip side is we love the car rental business. Hertz has 700,000 cars, and it's pretty easy for them to keep fleet. And so they were able to sell at auction at a premium to book value to move to their new business model. And what's hurt Uber has actually been highly beneficial to rentals as people have taken up long-term rentals from car rental companies. And we've taken positions in the Hertz post-bankruptcy as well as the largest European car rental business. And, it just goes across kind of industries and sectors and corporate services, from conference servicing to, travel and entertainment and
yes.
concerts and concessions. We see a lot of very good value for companies that will return back to maybe not, their full revenue lines of prior days, but say, 80%.
So
and
Bruce,
there's a lot of value in the process where it is today to get there.
I know you've already made sort of twice your money on Hertz, for example. When do you anticipate the airlines having these events, if you like? And I know that you're talking about some of the major U.S. airlines right there.
Well, we like the major U.S. airlines. I mean, American, United, Delta are great companies, great companies. When you look through all the airlines themselves, it's who's got the lowest cash burn, the most flexible business model, and those that do will make it through. Others that won't may have to be nationalized at certain, European countries, and so they may take the flag flyer of that country and nationalize that airline, which is not good for the equity, nor potentially for the debt. But how long does it take? Well, we have our models, and we're running the cash burn, and we're running our recovery rates, and it's a function of time and the path to recovery that will dictate that. But it may take 5 years for us to return to the old trend line that was in place for these last 10 years.
So, Bruce, how do you look at hospitality more broadly then? You said that there are very definitely some great opportunities there, but how do you value the collateral? How do you plug it all into your timeline and decide what to do now versus what to wait on?
Hospitality is an interesting sector. We had a big hospitality portfolio in the UK. Thankfully, we sold it, as you know, right before Brexit and right before COVID. And we're in the process right now of bidding on a couple of properties in Europe in the hospitality sector. So we like hospitality in the right locations, but we want to buy it for cents on the dollar. You segue away from hospitality and you focus on, say, office, for instance. And, Zoom is the inverse of office. I'm here at One Bryant Park in New York City on the 38th floor where our corporate headquarters are. And we have about 20% of our team here. And this is a 55-story building, glass building, beautiful. It's 5% occupied. And so, New York City, San Francisco, maybe they're going to run at 10% occupancy in the next 6 months. And so offices will recover, but also it'll take years. Crime is up in these major cities and services are down and tax policies aren't so friendly, so businesses are moving. Marathon's committed to New York, but these office leases will roll, and they'll roll at much lower rates. I just heard about the deal on Park Avenue, where it's 25% of the old leasing rate is where the sublease for 7 years just came in. And so the vacancy rates are going to go up, and it's going to be ugly. It's going to be ugly for property owners. You take a look at high-end condos, for instance. I was just speaking to a broker over the weekend who's given me a market update on New York City, and there's 10 years of supply, 10 years of supply of high-end condos, 5 million or more, based upon all these skyscrapers they have built in the last 2 or 3 years that's unsold. And so you tell me what price points are required to clear that when 2/3 of the buying interest from outside this country is no longer buying.
I guess that's the big question, Bruce, and that's what you're there to solve. So, Bruce, are you saying that even with yesterday's vaccine news being basically the best case scenario that we would have hoped for at the beginning of the vaccine, so some kind of signal of hope, plus the election being over at the very least, that hasn't changed anything regarding your outlook in terms of a timeline or what you're interested in?
I think it has. I mean, we're bullish and we're optimistic. Just that path is going to take some time before the virus vaccine arrives. It's going to be, a long winter and maybe a long spring. And so that time is going to be a tipping point for many, both in real estate as well as, with companies. For instance, we're loading up in the residential sector. We love residential housing. And so we're buying, single family rental property portfolios. We're buying packages of whole loans directly from the banks, the originating loans, Freddie K's, which is a subordinate structure of the multifamily segment, buying those at really healthy yields, high single digits, low double digits. And in Europe, there's a lot of non-performing loans that are now finally starting to come back into play based upon this new condition that took place in 2020 that's going to lead to just we think an extra trillion of NPLs come out of European banks.
So, Bruce, where are you buying these packages of residential real estate? I presume after what you said, not in major cities.
No, it's national footprint. There are portfolios coming out of commercial banks that have sold some of these portfolios to us because they're reperforming loans or, they're non-conforming loans that they want to part with after having originated. So we're putting substantial money to work at what we think are very attractive prices.
Bruce, let's get straight to the point on things like hotels. How do you decide, who is going to make it out of this? Are there brands that are much more obviously able to weather this? And, I know you don't touch retail or energy really anymore.
It's really a function. It's really a function of location, and an entry price for us. And so buying it through the debt at cents on the dollar at a big discount to construction value is what we look for in prime A locations. And so we have our hotel operating partner, and it's quite easy if we don't like the brand to simply reflag that hotel to a brand and a cost structure that most fits us. So it's a little less about the brand and a lot more about the property and location.
And so is prime location the same as it used to be? I mean, is New York City prime location anymore?
It'll all come back hospitality-wise, we think. New York City is not what it was. In fact, I put together an internal cast team. We looked at Charlotte, we looked at Atlanta, we looked at Miami. Miami won. And so Marathon's next 20 hires, half of our team will be down, in Miami. We'll keep the investment team here in New York. I'm certainly committed to New York City. I love New York City. But Marathon South will be an option for our employees. So I think where people travel to, and where people work and what business travel gets done as a result, will not necessarily benefit New York City in these next couple of years relative to places like Charlotte, Atlanta, Nashville, Miami.
And that's certainly a tax issue as well, I imagine.
The taxes, and taxes are, you reported about the billionaires that are leaving New York City that are going to tax-friendly states. And it's not only that, but it's some of the crime in the city, which is very unfortunate. I think hopefully that'll correct itself and policy be put in place to return to normalcy. But that's unfortunate because COVID's a lot to deal with. And when you deal with your personal safety in the streets, it's also a consideration.
So, Bruce, I know that you mentioned that you've done a lot in healthcare recently, and I'm curious as to what parts of healthcare, where are you looking? Is it COVID related? Is it sort of post-COVID related when people will get back to doing what they should have been doing during this time?
We love the healthcare sector. We've seen the healthcare sector, post, actually pre-Pfizer announcement, but post-announcement as well, continue to have some legs. And give you, a couple examples here. We took a healthy position in a company called Team Health, which is a physicians management company. is focused on elective surgery and is a Blackstone LBO company. And we bought the debt in the high 60s and 70s, and we think it's on its way to par and par plus. Just now this week, we're taking a nice sized position in a ambulatory service company at a similar dollar price in terms of our entry price, and we also believe that's a par recovery. And we're accumulating a position. I can't mention that name because we're still buying the position, adding to it. But Q2, the hospital admissions here in the United States down 13%. Emergency room visits at the hospitals down 33%, and elective surgeries down 70%. And we think all that will recover to its baseline trend, which is growth, and will recover within 1 year of today to 100% recovery. So Marathon is very focused on what's going on in healthcare, and we just put a $125 million commitment where we funded a company called Acquisitive and bought the royalty of this Parkinson's FDA-approved drug. Marathon purchased the royalty called Kenobi and is receiving a fixed percentage of global sales. Our partner is a great company called Synovian, great CEO, strong balance sheet, and great ability to distribute this pharmaceutical, this drug on the marketplace. So we're very happy with that. And we have a medical advisory board, leading scientists. Shout out to my Dr. Evan Bedell here at Marathon, who's doing an amazing job.
Absolutely. So, Bruce, are you going to provide rescue financing to places like hospitals and so on? Is that also part of what you're looking at? And on the airlines, do you see yourself providing some rescue financing to some of them?
It's rescue financing. We've already done that with a couple airlines outside the United States, and we'll do that with more. And it's everything from waiting for the bankruptcy and providing a DIP loan to securing up against their aircraft or their gates or their royalties programs in terms of points. And there's all kinds of opportunities, including in security form, ETCs and double ETCs. And so how we play that is, I think, company by company, depending upon their assets. We're avoiding anything in aircraft that are wide bodies, focused on narrow bodies, and focused on midlife aircraft as opposed to end-of-life aircraft. At this point in time, we think that's the best point of inflection for value and what we're trying to accomplish.
And in healthcare, is it hospital groups, distributors, suppliers, supply chains?
Everything. I mean, think about the services that happen around an airport. We mentioned Hertz, but you think about any concession.
No, I mean healthcare, Bruce.
Oh, back to healthcare. So, we love the healthcare sector, and it's something we'll continue to commit capital to. And when you think about everything from the hospital corps to the insurers to the pharmacy benefit managers to elective care, devices, and pharmaceuticals, the sweet spot for us has been funding companies' growth and buying royalties in order to do so in a senior secured basis, as well as some elective surgeries and some of the essential care around hospitals, because we've been able to buy that debt at 60 to 70 cents a dollar, which we believe are strong companies that have just had a temporary setback, but is a par plus recovery.